Well, look, like, I think the one thing that you've had the mortgage office for like over 10 years. So when you first started, like, how did you even stumble into private lending? Because I think that's the one thing that I feel like every time I talk to lenders, it's like they either fall in the industry kind of by accident almost.
I
But,
did. I
but yeah,
did. I
good
did.
for you.
I was
Okay.
a I was a personal injury lawyer, Nate, and I literally had never done I'd done one mortgage in my life, my wife and I, when we bought a house together after we got married. That was it. I knew this much about mortgage business. And I was at a firm and decided to leave, go out on my own. I've been on my own before, wanted to go back on my own. And I had a woman at the office. She left with me and she said, "Hey, my boyfriend is a mortgage broker. Why don't we start in Texas? You can be a fee office title company." Okay. She said, why don't we start a fee office title company, generate some revenue while we're building up the law practice? And I was like, well, that sounds like a terrific idea, except neither one of us knows anything about title or real estate, right? And so she was like, yeah, that's a problem. And I said, okay, well, I'll call one of my buddies who was a tax attorney who was also had a fee office. And I called him up and said, how do we become a fee office? And he was funny because he was like, well, you don't know anything about this. Why don't you just refer this up to me? And I was like, well, no. I go, we want to figure it out. Just introduce me to the guy. Who do I need to talk to? And so he introduced me to the guy that ran his fee office. And the guy said, you have to hire an escrow officer in order to have a fee office. Okay, so we found an experienced escrow officer. We hired them and they gave us a fee office and we started to do title closings. Not very many, because in Texas, when you first start a fee office, everyone knows you don't know what you're doing. And so you get all the crazy transactions that nobody else wants, right? And in Texas, title is the fees are promulgated by the state, right? So there's really, you cannot negotiate the fees, right? Maybe your escrow fee will be a little different, or your deed prep or something like that. But title insurance is promulgated by the state. $200,000 closing, $200,000 title policy. This is the charge, right? It's 1,600 bucks.
Yeah.
Right? It's just there's a formula, there's a chart, there's no haggling. So what happens is when you start a fee office, you get a lot of transactions, like I said, that nobody else wants to do, right? That are a lot of work, but you don't make much money, right? So smaller transactions that are trickier, i.e., wholesale transactions, right? I had never heard of anyone wholesaling a home when I first got into this business. I had a
What,
wholesaler come to my
what year is
office,
this? What year is this, would you say?
2000. So I left in like 2005. Uh, we probably started the fee office, 2000, end of 2006, part of early 2007. And then once we got it going a little bit, we were probably in late 2007, early 2008. Okay. And
Perfect
we're
timing.
doing wholesale transactions, right? Crazy time to be doing it. Wholesalers start coming to our office, and uh, Mark Bloom of Net Worth uh, and I became friends. And he explains to me his business, the wholesale transaction business. And we're at lunch one day, and he says, "You ought to be a hard money lender." I said, "I don't know what a hard money lender is." And he said, he goes, the A to B transaction, I close, I buy it, and B to C, I make them use cash or hard money because I need to get my money back so I can do another deal. I was like, okay, okay, yeah. And he goes, and he laid out to me, he's like, here's what you can charge, here's what you can do, here's how I would do it, blah, blah, blah. Okay. And so I at that time, I've got my partner, and also I'd ran into a college friend of mine who had been at a big firm, a bankruptcy lawyer, and I told him, well, just come share office space with me, right? Like, he's trying to build his own practice, right? He does totally different stuff than I do, and he, I tell him what I'm going to do. I said, I think I'm going to do this hard money lending stuff, and he's like, well, you don't know what you're doing. You've never done loan docs or anything like that before. And I said, you are correct. And he goes, well, let me do the loan docs for you, and at least I'll protect you. And I was like, great. And he goes, but I'll charge you, $475 for the loan doc set. I was like, I don't care. I go, because I'll pass the cost on to the borrower, so it doesn't really matter. And so literally, and I have this New York Times frame from July. It's funny. I'm looking at it right here. July 15th, 2008. Okay. And the reason I have that is that's the day I did my first loan. And so my mother and I did my first loan. And then a couple weeks later, a buddy and I do my second loan. And now I'm out of money. Right. And so, we were doing, I did these two loans. Guy calls me, can you do another loan? Well, now I got to find the money.
Were they
So
fixed
this is how,
or what kind of loans were they to start?
yeah, 6 month fix and flip, right? There was no refining out then, right?
Right.
There was no lenders that would refi you out. It was all fix and flip. And that's when I did my first couple loans. And then I would start calling buddies and say, hey, look, I'll put you in this loan, put you in a first lien position. I'll pay you the 14% interest. I'll make some points and fees and I'll service it. And if I have to foreclose for you, I'm a lawyer. I'll foreclose for you, right? We're just doing this in DFW, right?
Right.
Just a moment. And that's how it started. And I'd call friends, I'd dial for dollars, right? I'd put their name on the deed of trust. I'd service it. I was doing 2 loans a month, 3 loans a month. And my friend that had said, hey, I'll do the loan docs for you. He saw that I was starting to get some business. He's like, well, we got to start a company together. And we went to school at UT. Let's see, Longhorn Investments, right? And so we started Longhorn Investments, him and I. And then we got approached by a guy from a real estate investment club and said, you guys should come to our meeting. I heard you guys are doing loans. You can come talk to us about what you're doing. And, some of our people will probably, be interested in your services. And we were like, okay. And so they let you come for free first. And they're like, hey, if you want to keep coming back, you got to pay and be a vendor, right? All this stuff. And so literally this is how we started Longhorn Investments. That's how I started doing this business. And I did it we did it like this till 2010. Okay. So for about 2 years, I'm dialing for dollars on each individual deal. And then I go to the Pitbull conference, okay, in Vegas, 2010, because my partner at the time has been telling me we should start a fund. And I really don't know much about the fund, right? Remember, I'm a personal injury lawyer. I'm not a securities guy, structured guy, real estate guy, anything like that. So I don't know much
You were
about
kind of selling off to investors at that time. You're really just going to individual investors, and we call that trustees in California, for example.
trustees. We're doing trustee lending. Exactly what we're doing, right? And so we go to Pitbull conference. We listen to Leonard Rosen, John Hornick speak, right? And we kind of look at each other and like, we got to do a fund. Like, we got to do a fund. And
so you're at that conference. So you ended up meeting, who'd you meet up with?
AJ.
AJ. It's always AJ, man.
AJ.
He's been here for 20 years, and man, he learned a lot from him.
Yeah. And so I met AJ in 2010, and I think it was 2010. Had to have been 20.
Because you've been a customer since like 2011. So
yeah. So and it's probably in November when they had that conference, right? Or whenever they had it, right? Because it was in Vegas. So I know it wasn't the summer. I know that for sure.
Right.
And I told my partner, I go, we're buying the mortgage office. And he's like, hey man, it's expensive, it's da-da-da. And I'm like, because I was the front office and the back office, right?
Okay.
And my partner was the marketing guy, and he was the underwriter, right? And so I was doing everything on spreadsheets, right? Loans,
That's how everybody
investors.
starts. It's always Excel, right? I mean,
So
and
Excel.
how many loans did you have at that time? Do you think?
2010. I mean, we had probably done 100 to 150 loans, maybe.
So you're probably
Maybe.
20 million or so under management, or is that accurate?
No, that's not even that much, because that's overall how we've done. So a lot of them have already paid off.
I
Probably
see.
10.
Okay. So just getting started back then.
Yeah. Because we didn't have the infrastructure. Like when I went and met AJ and I saw him, and there was another software right next to AJ. And I remember I talked to both of them, and I looked at it, and AJ showed it to me, and I just went to my partner, and he's notoriously cheap. Okay. I don't want to disparage him, but he's not my partner anymore. But he didn't want to spend any money, right? And I was like, I'm buying this. I go, because I can't keep doing what I'm doing. Like it's impossible. I need some help, right? And so
What was it?
um,
What was the last drawback then? Just everything manual, or what was what was the
well, I
problem?
was pretty convinced that I couldn't find $200,000 of some investors' money.
Yeah.
Like he couldn't tell if I'd sent it back to him. I wasn't sure if I thought I sent it back to him. You know, my line back then, Nate, was pretty funny. Is that, and I regret saying this, right? This was now I'm feel foolish saying it, but I was telling my investors that I'm like, I don't know anything about accounting, but I can count money, right? Like I'm like, I don't know how to do this book wise, but I can track this stuff and I can do what I say I'm gonna do, right? Um, yeah, I'm looking at this in TMO in 2010. I've got 7 loans in there, right?
That's wild. Well,
Great.
what's funny, Mike, is you've always taken a data approach to this, and it's like you're literally able to jump in right now and look at loans from 14 years ago.
Yeah.
And so so talk about that. So you've gone from the trustee side where you're literally raising capital from individual investors to starting a fund. What kind of changed now going into more sophisticated, like what kind of pushed you into looking at even more sophisticated investor relationships?
Because this is the simplest thing I can tell you. In 2010, I had 7 loans in TMO. In 2011, I had 149, right? So for me, I saw the possibility of what we could do in this business, but I needed a way to get there, right? I
Right.
felt I could raise more money, right? And I could raise more capital. And I felt the fund structure, my partner and I believe the fund structure was the way to go because we can't constantly be looking for money on an individual deal, right? I can't keep doing that. I need to have confidence that if I do 10 loans in a month, I can fund all 10 loans, right? I can't feel like, oh gosh, what if Bob doesn't pick up his phone today, or I can't get a hold of Mark, and what do we do? Right. So I got the data, right? We got TMO, and now I did 150 loans in 2011,
That's
right? Because now I've got TMO, now I can be confident when going to borrowers that we can manage this, that we can service this, to investors that I can track it, I can give you the data, I can give you the information. And now you want to know how I get to the next step is I went to a bank and said, I need a line of credit. And when you go to the bank and need a line of credit and you're running spreadsheets and they go, give us your data, how many loans you do, how much losses do you have, how much revenue you earn, all that, you are scrambling, right? You're just totally scrambling. You're not tracking it well. And maybe you've got it in QuickBooks where you can give them some numbers on how much interest you collected or this or that, but you don't have the data on your portfolio. I just don't think you do, right? You don't, you're not sophisticated, you're not professional. It's very, very hard to do and scale your business, right? So now I've got TMO, I've got this. I've been to 7 different banks before over the last year and a half, Nate, and got turned down by every one of them. And
wow.
finally, Veritex Bank, uh, I go meet with them. I have a great meeting with them. A week later, they give me my first line of credit with $1 million. And that was 2012, I think,
Yeah.
right?
So shortly
And
after getting the mortgage office, you're now attracting sophisticated capital.
well, so what I did was, and look, the hard part of Nate is we're doing trustee lending. To convert to a fund, you got to convince your investors that it's better for them. And a lot of investors don't agree with you. They like being on an individual loan. They like having control of that asset.
Sure.
They think they're doing some of the underwriting that they think, oh, I'll do that one, but I won't do that one, et cetera, et cetera. And you have to be disciplined and tell them that you're not going to give them any more deals unless they go into your fund. If you really want to build a fund and build a business.
So how was that transition? Because that's obviously, a contentious point for our customers because, you have investors that want to be hands-on, but you're right. It's like to have more control, you need to push into a fund because then you control everything.
That's
So
right.
how did you
Well,
talk to your investors at the time?
I told them that it was far riskier the way they were doing their deals now tied to one loan versus a fund where they're tied to 100 loans right at the time or 150 loans, right? I said, if this one loan goes bad, you're stuck. You're not generating any return on your money. And I've got to go foreclose for you. You've got to decide what to do with it. There's cost, um, there's time, there's all these things afforded to it that are going to reduce your return. And their initial response was, well, but I'm getting 14% on my money right now. You're telling me in the fund I'm only going to get 10. I said, that's correct. But you get 14% when your money's in play. I can't always keep your money in play, right? I do a loan. The loan, if I got to foreclose, you're tied up for a little while. I'm not paying you any return on that. The loan pays off, let's say. I get your money. If I don't have another deal for you to go into, you go back in the queue, right? Because I got to talk to these other people that I've been talking to that I promised to get in the deal. So you've got to wait your turn. So I said, yes, you get 14% when your money's in play. But if you give it to me in the fund, your money's always in play. It's always working.
Now, are you
And
doing, do you do quarterly distributions? Do you do monthly distributions? Do you like did that play a factor into it as well?
so, for us, it wasn't that much of a challenge. Initially, right, if you're in trustee lending, you're paying them on a monthly basis, right?
Right.
But when we were going to go to quarterly, we were going to go to the fund structure. We were going to switch to quarterly distributions, right? Because you got to run the P&L, you got to do some stuff. We wanted to be very timely about that, but we wanted to build it up too to make it some significant dollars, right? The amount of loans we had at the time, monthly, I mean, to us, it seemed, I know a lot of funds do it, but it seems silly and too time consuming and the amount of money they're getting. Why are we doing monthly, right? So we did quarterly distributions. But I convinced my investors that less risk, more consistent return. But I knew for me to hit that, I needed to have leverage, right? So it all tied together. I had to have software, right? I had to have line of credit, and I had to have loan flow, right? You had to have volume. And you got to make all those match together, right? And that's the trickiest part about this business, from a lender standpoint, is matching your cash flow with your volume. You have too much cash, not enough loans, you can't deliver a return, people are going to want their money back. You have too many deals, you don't have enough cash, borrowers are going to be like, well, if you can't fund my deals, why am I going to come see you,
So
right?
and I guess that's a good point to a new lender that's getting started. It's like, how would you give them advice on to balance that? So it's like, how are you going to tell them to, how are you going to balance not having too many deals?
Yeah, well, look, you've got to manage the situation, right? When you're starting off as a trustee lender, you better have enough relationships where you can go to enough people, because you want to go to just one guy. Because what if that one guy
Well,
decides he doesn't
that's-
want to do it anymore?
Sure.
You got to go to multiple people. You got to have it available. And you've also got to be able to match your marketing. If you're out there pushing loans and loan volume, um, the key is you better do what you say you're going to do. If you're going to fund the deal, make sure you can fund the deal. If you can't fund the deal, then say no to the loan,
Own it.
right?
Yeah.
And be honest about it. Don't try to, I think some lenders try to manage their loan flow by just turning down the deal,
Sure.
right? And not telling them why, or telling them they don't like the property or something like that. If the deal makes sense and you like the deal, but you can't fund the deal with any money, I'd rather be honest with them and tell them we don't have the money to fund the deal. But you better have the money to fund a deal if it's a deal you want to do, you know?
Right.
So you got to line your stuff up, and you've got to be willing to put skin in the game too, right? I think that's a big deal. Like for me, it was an easy tell to investors. It's like I funded the first couple deals. I took the risk, right? I didn't go to some third party and say, "Hey, will you fund this on a deal we've never done?" Right? And so I constantly was funding deals, right? As my money came back, I put in another deal. If I made more money, I took money, I put in another deal.
Did you have
And then
relationships with other lenders in the area where, like, if a deal didn't make sense for you, you could intro somebody else?
nope,
So
nope.
all organic to Longhorn. Okay.
Yeah. Now, if somebody new today, if you can't fund a deal, come talk to me. I could probably fund your deal for you. I mean, yeah, I got no problem with that. If you're
Sure,
in the
right.
I'm in, sure. But the tricky part about that is, let's just be honest, is that, well, is that borrower going to come back to you, the original originator, or are they going to come
That's
to
fair.
Longhorn and we can fund the deal? I mean, just being candid about it.
Well, and what you're seeing now, which is interesting in the space, is a lot of aggregators. So you have one lender that's sitting behind the scenes, but that is kind of being funded by multiple different aggregators. So you are seeing that set up more and more in the private space, especially on the East Coast. Um, But I guess, Mike, what's interesting about something you said earlier is that you chose on day one to service loans in-house. It's very common too for private lenders to kind of look at two options. Am I going to outsource my lending or servicing, I should say, and they're thinking they're outsourcing their problems, I think, with that method. You chose to service, I guess. What led you down that road?
Control. For me, it was all about control, right? I didn't want to have to, if the borrower was late, I didn't want to have to wait for someone to tell me the borrower was late, right? If the borrower wanted to do a draw, I didn't want to have to wait to tell someone to, or tell them to go do the draw and hope they do the draw in a timely manner, right? When you're first starting this business, especially when you're small, you got to sell speed and efficiency, right? How am I going to compete with the bigger guys, right? They've got more money than me, they've got more marketing, all that, but I can give you the personal touch. I can work quickly. I can work with you. If you've got a delay about something like that, we can work something out. If I outsource that to a third party, I got to wait for them to tell me the information. Then I got to make the decision. I would much rather have direct communication with my borrower. And then we can work on problems together.
Right.
Um, and I want the data, right? So I can go to my banks, I can go to my investors, and I can show them. I don't want to have to wait 30 days for them to do a reconciliation and tell me what's going on. Like, I don't, if I'm not servicing my loans, I mean, how am I going to tell you this information? I'm looking right here. I can tell you how many loans I did in 2011,
Right.
right? Now, maybe today is more sophisticated. They'll give you an access. You can log in. You can go see what's going on. Third-party servicer. It's great. But for me, all about control, all about giving the best service possible to my borrowers, um, and me building that up. And I'm in charge of that situation. I'm not relying on a third party. I mean, sure, there's some cost as well, right? That goes along with that. But I don't know. I think we looked at it one time.
Right.
Early on, we looked at one time about using a third-party servicer.
What's a revenue stream for you too, is right. I mean, if you're outsourcing, you're paying somebody else for the service. I think what's interesting, Mike, I find you guys are constantly calling us to add another license of our origination system. It's like you're always adding new originators, but your servicing stays constant. So how many loans right now are you managing? Like right, it was like six.
1,757, I think.
Wow, okay. That's awesome. And right, roughly like, you mentioned about 450 million. So you've grown, incredibly fast with a pretty lean team from servicing. But you've been
Well, fast is relative, right? We've been doing this for 16 years. No
Yeah,
worries.
but no, you've been growing extremely fast in Dallas as of late. And it's like I guess the bigger thing I call lenders up and down, especially in the Midwest. They know your name. Like they know Longhorn is coming into Kentucky, coming into Ohio. So, you've stayed relatively lean on the servicing front, but you've expanded your origination into all these different markets. How have you done that? Because lending, especially with what we do, is pretty localized unless you're trying to be like you have everybody's big lenders playing in these big like these different spaces, but you're competing in a lot of localized markets in the Midwest very effectively. Like what's been your play there?
Yeah, so, look, we try to be very centralized in our underwriting, processing, servicing, right? So we do that primarily here in the home office. We did learn with COVID, though, that people can work from home. And if they're working from home, does it matter if they're in Dallas or does it matter if they're in Arkansas? Does it matter if they're in Kansas? It doesn't really matter, right? So we built out kind of our processing team and servicing teams that way. But look, in the servicing, you guys have had so many things automated, right? Collecting payments, right? You run an ACH batch, it takes 5 minutes, upload it to your bank, boom, 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 you collected your payments, right? People are late, send out late notices. You guys takes one person, go through who didn't make their payment on time. 3 clicks of a button, send it out, late notices go out. NSF comes back, boom, 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 4 clicks of the button, NSF notice goes out, charges it to the account. I mean, look, you guys have automated so much of, like, I giggle if I was trying to still be on spreadsheets servicing 1,700 loans, I'd have 150 people, right? I mean, it wouldn't be profitable, right? It wouldn't make me any money. And so I think the ease of use of, and you know me, I'm a big fan of the TMO servicing, right? I like the legacy software still. I know I need to look at the online platform. But the legacy is really easy to use. It's very effective, and we can do it with a relatively small team.
So one thing that's awesome about the Longhorn story is you guys have literally you've done trusted investing, you've started a fund very successfully, multiple funds. Then you went and got more sophisticated capital from different banks, and now you've gone through the acquisition phase of Skybeam. It's funny, I was just talking with a firm in Georgia who was asking me, it's like, look, as we grow our operations, how do I attract a company like Longhorn to look at us and say, maybe there's some synergy here? Because those are the
Right.
questions now that these smaller lenders are doing. How do you evaluate a small lender? How do you say, or a mid-sized lender? How do you say this is what this company is worth, and how you can build synergies between the companies to eventually acquire them and keep the growth that you're having?
Yeah, look, I think, the first thing you have to do is look at what kind of loans they're doing, right? When we're evaluating somebody, are they doing loans that we do, right? Does it make sense for us to have a conversation?
Sure.
Or if they're doing different types of loans, do we look at it and go like, huh, maybe this is something that if we added this to our portfolio, this would give us a competitive advantage, or this somehow makes sense to blend these two together, right? So I think that's the first thing you have to do is figure out, the underwriting and does that make sense? How do they do it? And then secondly, and I think probably more important is like, how do they view the business, right? Like, how do we view the lending world? How do we treat borrowers? How do we treat investors? And, with us and Skybeam, it was really easy because, Mark and I kind of look at the world very, very similar, the lending space. Like, we're very customer centric, very focused on giving great performance, great service. Um, trying to be really upfront with our borrowers. Like I'm a big believer that a quick no is just as good as a quick yes sometimes, right? If
Sure.
the deal doesn't work for us, let them know. Don't string them along, don't drag them out, and just do what you say you're going to do, right? And if you're going to do the deal, do the deal. If you can't do the deal, tell them you can't do the deal, but don't drag them on, right? And I think in our business, that has changed a lot over time, right? When I first got in the business, I had a lot of calls from people. My lender fell out. They can't do the deal. Can you help us? Right? There was a lot of that going on. I don't think that is the case nearly as much anymore because the business has grown up. The business has matured, become more sophisticated. People
Right.
have real capital, real institutional capital behind them that they're confident they can fund their transactions. Um, Little segue there. But for us to look at other lenders and the valuing company, it really look, there's multiple things to look at, right? What's their structure? How much capital do they have? Are they selling off their notes? What is the value that they bring where we want to look at them and go, this makes sense for us. And then what does their team look like? What does their principal want to do? How involved do they want to be? I mean, these are all things that we're going to look at and value. But I will say this, I think it is really hard to value companies in our space, right?
Totally.
What is the value, right? Is it how much capital you've raised? Is it how many loans you originate? Your performance level? And I think each potential acquirer or purchaser like me, maybe we're looking for different things, right? Maybe a big institutional guy with tons of capital is just looking at a loan originator, right? That's what's important to him is loan origination. A guy like me, I'm more interested in your capital because I figure out I think I know how to originate loans, at least the kind of loans that I want to do, right?
Right.
Um, so I think it's beauty is in the eye of the beholder, right? What might be attractive to me might not be attractive to somebody else.
Well, totally. I think the one thing that was interesting, Skybeam in particular, they were servicing in-house, and I know that that has been a big piece. If you talk to some of the other organizations that have, acquired their firms, that in-house servicing adds the valuation bottom line because it's one of the few things that's actually providing, for lack of a better term, ARR to the bottom line. It's like there's a lot of one-off transactions that happen. Servicing is consistent every month. I've heard stories of some firms actually surviving through COVID off of their servicing portfolio because it was so large, and they had spending at the time, froze lending at the time.
Yeah. Yep.
So I know when you were looking at that aspect, technology plays a factor, right? So there's other systems that folks use. how did that process go? Was it tough to kind of integrate? You looked at other starter systems compared to the mortgage office that you've been running on. What was kind of the defining factor of we're staying with TMO and we're going to double down on basically integrating this system into a new company?
Couple things there, Nate. One, and we've talked to lots of companies, right? We got the deal done with Skybeam, but we've talked to lots of other companies. And if we're talking to a company and they couldn't provide data that I needed, how many loans you're doing, what's the current portfolio look like? Look, if they say, well, give me a couple days, or they couldn't provide everything I was asking for, because either their third party was using it and they had to go find from third party, or maybe their software wasn't as robust as we would like. It makes you really hesitate to want to get into business with them, because how can you rely on the data if they can't produce the information that you need? How can you make the decisions to move forward together or not, right? So that's one component to it. The second component is when we decide to move forward, that if we looked at the software, especially on the servicing part, right? That's super important to us, right? The origination part you can figure out, right? But the servicing is super important to us. That we thought TMO, the servicing was, vastly superior to anything we've seen from the other organizations that we spoke to. And I think kind of the proof's in the pudding that, after our merger, that they agree with us, that they've said the same thing, right? That, wow, this is better, right? Because just some of the information, the fundamental information we need, it's at your fingertips, and it's not always with some other softwares that we've looked at.
For sure. And I was going to ask, because change management's hard. It's like, you've been using something forever and now you're being acquired and you have to change systems pretty quickly. So you're saying they actually adopted it pretty fast and they didn't skip a beat, or how has that process been?
Yeah, I mean, honestly, they like it better. And it's funny, we're relatively new into the Skybeam relationship, right? I mean, we closed September 30th, right? So we're 40 days into this relationship, and we have weekly integration calls with their leadership team. And today we had a call right before I was on the call with you, and it was like, I was like, what are the complaints? What are what are the things we got to deal with? How are we doing this? And it was like, really don't have a whole lot. Like, the software platform, this, that, and literally it was like 10-minute call. I was like, no, we don't. And we've heard from their servicing team that they really like it. And makes us feel good. Oh, hold on. Makes us feel good that that it's been very easy for them to adapt.
Awesome. So, Mike, looking ahead, I mean, where are you seeing things going for the industry? So I think that if you talk to a large number of private lenders, you're seeing consolidation. You're seeing some larger players really taking a lot of market share right now. But there's also still this localized small private lender presence. So I'm kind of curious to take, what you have to say about that, because there's a lot of different opinions, but where do you see the industry headed in the next 3 to 5 years, especially, under a new administration?
Yeah. Look, our business has gotten way more sophisticated over the last decade, right? Institutional players have come in, far more sophisticated people. This used to be a very, very localized business, but it still is. There's plenty of room for local players in this if you can provide great service. You got to differentiate yourself, right?
Sure.
You're probably not going to compete with price on with the big boy, right? National lenders, something like that, they're going to come in there, be cheaper, but you can be better, right? You can provide better service. You can more personalized, talk to the borrower. They're not just a name, not just a number, right? They one of the things that we try to pride ourselves on is that we're looking at the deal and we want to tell you if it's a good deal or not, because we want you to come back and do another deal with us. So if we do a loan and it's a bad deal, you have a bad, taste in your mouth, you're not going to do any more deals. We've seen tons of people do one deal, burn bad, they're out, right? They lost money on the deal, they're out. We want to make sure that we're looking at the deal with the borrower, make sure that they can be successful at it, right? Number one. But where this place is going is there are probably going to be more institutional letters come in. There probably is going to be more consolidation, right? They're going to try to do that. But I think there's always room for somebody that provides, they do what they say they're going to do, provides quality service, competitive rate. Borrowers do value that, right? I think borrowers do value that. But look, also, we've seen securitizations, right, happen in our space. So that's
Sure.
another form of lending, but you can't do a securitization unless you're a big boy, right? You got to be 100, 200, $300 million of securitization to make it worthwhile. Otherwise, securitization costs too much.
Right.
So, um,
Is that something
I
in the future for Longhorn? Is that something that you're looking at potentially?
mean, we've looked at it in the past. Something I'm sure we'll look to in the future. We're always going to look at new stuff. You can't be afraid of doing new stuff, Nate,
Right.
because if it makes sense, if the cost is there, but you got yourself, how much is it going to cost us to get there? How much time and effort is it going to take? And what is the benefit for not just us, for our borrowers, our investors? How is this going to help us out? Um, so I think you got to look at that. Um, and then what's really interesting about this business is that when I first started, I was always curious how many loans are being done like mine in my city or in my state,
Yeah.
right? And there was no way to know. There really was no way to know, right? Are you going to go look up every deed recorded and try to figure out who the lender is and figure out if that is that a hard money loan? Is that a 30-year loan? All that other stuff. Well, fast forward 10 years, and there are sophisticated groups out there, right? SFR Analytics,
Right.
Forecasa, that they'll provide that data for you. And when you go look at that data, Nate, it's pretty amazing how many loans are being done in our space now.
Right.
And I think it's going to continue to grow. I do think it's going to continue to grow. And look, with the new administration, I would assume that there will be less regulation, right? And so for an entrepreneur like me, less regulation typically better, right? So I would assume now that certain industries could be targeted, the housing industry could be targeted. I don't know, but I would assume that for folks like us in the private lending space, that you got a good runway still ahead of you.
Yeah. No, and that's what we're seeing. I mean, we're seeing higher loan volumes across the board, and it's interesting on the data point. That is something that we're really doubling down on in the mortgage office is we have tons of data now, especially with TMO Pro. How do we start to really provide opportunities to our customers that, just widen their doors a little bit bigger on what markets they can go to. There's a lot of expansion opportunities that lenders don't necessarily take advantage of, and TMO does make that easier, especially with some of the data analytics that we're starting to provide to our customers.
Well, and you brought this up a little while ago, and we didn't touch on it, right? Like, how do we go to new markets, right?
Yeah.
And so, we like to look at the data. How many of our type of loans are being done in a particular market? Who the lenders are there? What are their price points? What are their advance rates? Can we be competitive in those markets, right? And so that's how we kind of diagnose and figure out where we want to go to next. Where do we think our type of loan is going to play well? Who's out there doing it now? What do we have to do to compete with them? How many loans are being done in the city, right? And do we think there's room for growth? And so, what we like to do is when we go to a new place, I want to get somebody with boots on the ground that is going to be my rep in that city, right? I want my salesperson, I want someone in that market out there
So you're
pushing
hiring
our.
local on that market.
Yep. And then look, you got to spend time with your underwriting team. You got to spend time for us. We like to go, have an appraiser take you around. How do we look at the city? Because look, it's not your backyard. So how do you know if it's a good deal, not a good deal, good neighborhood, not good neighborhood? So you got to spend some time and effort, I think, to do it right.
That makes sense. And I guess switching gears a little bit, Mike, and I know just kind of looking at servicing as a whole. So, you have your lending, you have your origination, right? Just looking at servicing, how do you look at certain metrics within servicing to say, these are where I'm gaining profit margins. These are some items that might be hurting us in the servicing. How are you looking at your servicing portfolio as a whole from more of a financials perspective?
So, you're giving me too much credit there, Nate. Remember, I'm just a lawyer, right? So we don't get too specific about that stuff,
Oh,
right?
come on. I know you pulled data like the back of your hand.
We're simpletons. We really like to just like the focus, the metrics for us on the servicing portfolio is I'm super simple. 7 days late, 30 days late, 60 days late. What markets are those? Am I seeing a trend in a certain place? Am I seeing a trend from a certain referral source? I mean, this is how, look, this is your detective work that you're doing here. That are you performing the way you should be performing? And if we're not, what is the reason? Is there a common denominator of why a certain part of our portfolio is not working? And so I feel like that's a TMO's, the more data you put into it, right? The more information you're going to get out, right? So you guys have your baseline information that we can put in, but you have custom fields that we can put in that we can track and do certain stuff. And that's what we spend a lot of time on.
Got it. Okay. And I guess then switching to like some of your investors and some of what banks are looking for, or investors in a fund, what are some of the metrics that you can really call out that really helps to, just acquire more capital?
Yeah, well, I mean, the first thing you want to know, the first thing you want to know is how much capital do you have, how many loans do you have, and what's your foreclosure rate, right? I mean, that is that's
Those
what
are the
you
big
always
three.
ask. What's that?
Those are the big three.
Yeah, I mean, that's what they want to know. And then when we're dealing with, something we haven't talked about at all, not so much on the servicing or the TMO side, right? The sophisticated people, they also want to know advance rate. How much are you advancing on the transaction? And right, we're in an interesting space, right? Because people are loan to cost, people are after repair value. So that's another big question that folks that want to give you money, right? Especially
Sure.
on the institutional money that they want to ask and everything. And so, you know, that's data I didn't really think about before, that now we track, right? And so we can track this and we can tell them, you know, the amount of information that we can give. And I can't tell you how many times that banks have called, or we're trying to, work with a bank, or Atlas is our other provider, right? Veritex is one of our loan providers. Atlas, um, SP is another one of our providers that we've been told, they ask us for data, we ship it out to them, next day, same day, whatever. They're like, how do you do this? And like, because we've got it in our platform, right? We've got it in TMO, and this is stuff we've been tracking. It's always, they throw us off. There's always somebody that says, want something that we hadn't thought about tracking before. So then we got to go create the custom field. We can put it in, and okay, now we're going to start tracking this for them. But it's been huge that they want to do business with you if you can provide them reliable data quickly, right? They love that. They're like, yeah, you're the kind of person we want to do business with. We ask you a question for something. It's not weeks later that, oh, here's the data you were asking for. It's days, it's hours, it's minutes sometimes. And they're blown away by that usually.
I don't know. That's super interesting. I mean, do you find them looking more? And you mentioned like they're more interested in the ARV then? They're more interested in kind of what the forecast is looking forward than the current assets under management. Is that fair?
I mean, they're looking at they want to look back at your history, right? They want to look at your current platform. But remember, a lot of us in this space, we're doing 6-month, 9-month, 12-month, 18-month loans, right? So they want to see your history of past performance, right? Churn and burn. How fast are you getting through your loans, right? If it's supposed to be a 6-month loan, are they taking 6 months? They taking 9, they taking 12. What's going on, right? They want that data. And they want to know, how you originate, right? What is your concept? What are you doing? What are you looking at? What's the box you created? Are you sticking to your box? Right. By the way, key point for your young, smaller lenders that want to grow, you got to be disciplined and stick to your box. It's hard to borrow institutional money if you do not have a box. But I get how when you're a smaller lender and you've got some cash available, if a deal makes sense, you want to do it. But even if it doesn't fit in your box, but that is a hard way to grow your business, right?
Interesting. Okay, so you start digging a hole and you start getting bad habits, and that makes it harder to recruit new capital.
And I'm not saying it's a bad habit, right? That's the thing. It's not a bad habit. It's you have the time to go figure out if this loan makes sense. Because I've done that plenty of times, right? When I was smaller, hey, this loan, you know what? This loan makes sense. It's logical. It makes sense. I'm going to do the deal, right? It doesn't fit my box, but it makes sense. It's very hard to scale your business that way. When you get picked through by bankers or institutional investors, they don't love that because they're like, that's not a scalable model. And they're right.
For sure. And I think, what's interesting, I like talking from a small lender perspective because so many small lenders call the mortgage office, they're looking for information. It's hard to find. It's not easy. It's not just you can't Google a lot of this information. When you define a box, what are some of the main metrics that you're looking for? So if I'm a new lender, I got a couple $1 million already on the street, and now I'm trying to become a little bit more professional. What would you frame up and how has technology supported that?
Size of the loan, right? Are, are, are you doing $150,000 loans? You're doing 1.5 million, right? What are you doing, right? Where are you lending, right? What type of property are you lending on, right? Like a lot of guys in our space, hey, I do single family, I do commercial, I'll do some office, I'll do this, that. Okay. What is your underwriting guidelines, right? What are your metrics that you're looking at, that you're doing? Um, and then once you have those basic fundamentals, right, you can define who you are, right? And look, I've learned over the years, Nate, because I tried doing some different stuff. I'm very comfortable being a single family guy, and I love loans in the two to $300,000 range, right? And it's interesting because when I started, it was 100 to 150, but prices have gone up right over the last 15 years. And so now, to me, two to $300,000 loans, the value of the property is 250 to $400,000, maybe up to 500,000. That is 95% of our portfolio. And I like it. I understand it. I know that there's lots of borrowers or potential exit strategies for our borrowers, right? Buying, refinancing, that can put renters in there, they can cash flow where the return makes sense. I think it's really good if you want to grow and you want to be successful, like know who you are, right? And stick to it. And even though sometimes it's going to be hard to turn down that $2 million deal where you make 2.5 points on the deal and you want that cash in, but if it's not something you typically do, I say, hey, go work a little harder, find 10 more $250,000 loans.
Right.
And my sales guys don't love it when I say that. I'll be honest with you. They didn't love that for a long time, but you stick with it and you be disciplined about it. You can grow your business, right? And it's a better story for investors, right? Investors don't want to hear that you're all over the map. They want to hear that you're good at one thing. Banks, right? Banks love that, right? Banks don't want to see you all over the place. They want to see you've created a box, right?
Totally. It's kind of fun, right? Because you're the one managing all the capital. So if you're doing that, you really need to stay disciplined. If they're trusting you and signing off individually, I guess you can get a little bit more creative. But
for sure, because then they're acting as the underwriter on the deal, right? If they're signing off on the loan, if you're doing an individual loan, if the guy's comfortable doing a $3 million deal and he's putting up the money, go ahead and do it. But if you're managing a fund, it's more challenging. And look, I also say, don't totally box yourself in, right? There's some exceptions. If it's a good borrower, borrowers grow up, right? Borrowers do $150,000, $200,000 deals. They want to stretch their wings, maybe 350, 400, 500. Guy says, hey, I want to do a new construction deal, right? We've all kind of grown with the market and everything. We didn't do new construction our first 10 years in business, right? We started doing construction 3-4 years ago, right? Create a little different model, different program because you see there's a need for it.
right.
So look, you got to have a little flexibility, but really know who you are and everything.
Awesome. Well, Mike, I think we're coming up on time. I think this was great. How do you feel?
Feel good. I love talking about this. It's tons of fun.